6,000 stores. Used games flipped at 3 times the price. Midnight launches that turned malls into block parties. That was GameStop at its peak. Today, revenue is in freefall, and billions raised by selling stock to its own fans might be the only thing keeping the lights on. Is this a comeback or a company on life support? The answer starts with what made GameStop unstoppable in the first place. Walk into a GameStop in 2007 and you would find the engine that made the whole enterprise hum. 1 part pawn shop, 1 part clubhouse. The secret was not just new games stacked on shelves. It was a relentless loop: buy, trade, resell. Customers would hand over last month's titles for a fraction of their original price, usually about 30% of what they paid. The store would turn around and put those same games back in the case, stickered at nearly 50% of retail. That spread, often 2 to 3 times what GameStop paid, was pure profit. By the mid-2000s, used games were not just an extra. They drove the majority of foot traffic and accounted for roughly 30% of total revenue. Every trade-in was a hook. Kids and teens lined up with stacks of discs and cartridges, hoping to shave a few bucks off the latest release. For many, it became a monthly ritual: cash in, browse, repeat. The stores felt alive, especially on launch nights when crowds wrapped around the block for midnight releases. GameStop turned these events into minor holidays, with tournaments, giveaways, and enough energy to make even the most jaded mall security guard crack a smile. Behind the counter, staff kept the cycle spinning. Inventory moved fast. Used titles churned through the system in about 12 weeks, keeping shelves fresh and margins high. The numbers were hard to ignore. In 2008 alone, GameStop resold over 100 million used games, many at 2 to 3 times their buyback cost. The formula was simple but ruthless. Keep people coming back, squeeze every dollar from every disc, and make the store itself a destination. For a while, it looked unstoppable. Walk past the racks of used games and you would spot the real money: collectibles. Action figures, trading cards, Funko Pops, and branded gear filled the gaps between game launches and kept registers ringing even as digital sales started to nibble at the core business. By 2008, collectibles and accessories had quietly climbed to nearly 10% of GameStop's total revenue, with some years reaching high single-digit territory. The margins were even sweeter. While new games barely cleared 20%, collectibles and accessories could hit 40% to 55%, sometimes higher if the item was a store exclusive or tied to a blockbuster franchise. Store managers leaned hard into this side hustle. Every power-up rewards. Sign-up came with a nudge toward limited edition amiibo or a Pokemon booster pack. Holiday promotions and launch events offered exclusive swag, driving lines out the door and padding the average transaction by $12 or more. These tactics were not just for show, they worked. On Black Friday 2011, GameStop's collectibles segment posted a 23% year-over-year spike, fueled by aggressive bundling and timed releases. Even during slow quarters, the steady drip of trading cards and licensed gear softened the blow from weak game sales. Executives saw these numbers and convinced themselves the brick-and-mortar model could weather any storm. The thinking was simple: as long as people wanted to show off their fandom, there would be a reason to visit the store. But this confidence masked a deeper vulnerability. The collectibles cushion covered up the slow leak in physical game sales, making it easy to ignore the digital shift brewing just outside the mall. For a while, the numbers looked bulletproof, but the ground was already starting to move. On January 13, 2021, GameStop's stock price started doing something nobody on Wall Street had seen before. It wasn't just a rally, it was a detonation. The spark was a short interest so high it broke the math. More than 140% of GameStop's available shares were borrowed and sold short, meaning hedge funds were betting on the company's collapse with shares that technically did not even exist. This wasn't a glitch. It was a powder keg. Retail traders on Reddit and our Wall Street bets smelled blood. But it wasn't just about buying shares. The real chaos came from options, cheap, out-of-the-money call contracts bought by the millions. On January 27th alone, options volume hit 24.5 billion shares, or 57 million contracts. Every time a trader bought a call, market makers, big firms that keep the market moving, were forced to buy the actual stock as a hedge. That feedback loop, called a gamma squeeze, sent the price into the stratosphere. By 10:46 a.m. Eastern, GameStop hit $483. Brokers were not ready. Clearinghouses demanded billions in collateral to cover the risk. Robinhood and others slammed the brakes, restricting new purchases of GameStop and a handful of other meme stocks on January 28th. The official line was liquidity and regulatory capital requirements. The effect was instant. GameStop's price plummeted from over $500 pre-market to $193.60 by the closing bell. Congress hauled in Robinhood's CEO, Vlad Tenev, for a hearing on February 18th. Lawmakers grilled him about the restrictions and whether retail investors were being set up to lose. Regulators later confirmed the margin calls were real, not a cover for some shadowy conspiracy. Still, the damage was done. For a brief moment, GameStop became a symbol, a battleground between Main Street and Wall Street. Hope soared. The old retailer was suddenly the hottest ticket in finance, and everyone wanted a piece of the next act. Ryan Cohen didn't just buy shares, he bought the keys to the castle. On January 11th, 2021, GameStop announced Cohen and two allies from RC Ventures would take seats on the board. Wall Street rolled its eyes. Cohen wasn't just another activist investor. He had built Chewy into a $3 billion e-commerce machine and sold it for a fortune. Now he promised to drag GameStop out of the mall and into the future. First up, a digital overhaul. Cohen's playbook called for a total teardown of the company's aging website. In May 2021, GameStop announced a partnership with Shopify to rebuild its entire online storefront. The goal? To make GameStop the Amazon for gamers, fast, frictionless, and everywhere. By late 2022, the new Shopify-powered site was live in the United States, soon spreading to Europe. The company reported $1.1 billion in online sales that first year, a number that made headlines but fell short of the blue sky projections Cohen's fans had been whispering about on Reddit. Cohen didn't stop at e-commerce. He hired dozens of tech veterans from Amazon, Chewy, and Google. He greenlit a blockchain experiment, an NFT marketplace built in partnership with Immutable X, and launched it in October 2022. The pitch was to turn digital collectibles into a new revenue stream and lure crypto-obsessed gamers back to the brand. In reality, the NFT platform generated just $4.2 million in 2023, a fraction of the $15 million target. Marketplace glitches and a cooling crypto market didn't help. Still, Cohen's boardroom moves sent a message. GameStop wasn't going down without a fight. The company had a fresh digital roadmap, a new cast of tech insiders, and a war chest of cash raised through stock sales. Behind the scenes, every new initiative came with its own price tag, and the clock was ticking. GameStop's survival isn't just about selling games, it's about staying liquid. Over the past 4 years, the company has tapped Wall Street again and again, selling shares through at-the-market offerings. On September 10, 2024, 20 million new shares hit the market at $15.30 each, bringing in $306 million in fresh cash. Earlier rounds in April 2022 and July 2023 added another $285 million combined, all disclosed in 8K filings. On top of that, 2 convertible notes, $600 million at 5.75% from 2021, and $400 million at 4.25% from 2024, sit on the balance sheet with conversion prices just above recent trading levels. Every new share dilutes existing holders, but it buys time. As of June 2025, GameStop reported $1.24 billion in cash and $450 million in marketable securities, enough to cover about 15 months at the current burn rate of $80 million per month. That runway can shrink fast if sales stumble or costs spike. The math is simple. More dilution means more lifelines, but each one comes with a steeper price. The pressure is real, and the clock is always ticking. 8 numbers now decide GameStop's fate. First, cash runway. If the company's liquid reserves drop below a year's worth of expenses, that is a red flag. Next, dilution. If new shares water down ownership by more than 15% in a single year, alarm bells should ring. E-commerce growth is the lifeline. Any quarter where online gross merchandise volume shrinks means the digital pivot is stalling. Same-store sales matter too. A drop of more than 5% year over year means the core business is slipping. Inventory turns below 1.5 times per year, signal dead stock piling up. If short interest spikes above 120% of the float, the sharks are circling again. Watch insider trades. If net insider selling tops 2% of the float, confidence is draining from the top. And if gross margins sag below 30%, the cash burn accelerates. These are the tripwires. Miss too many, and the board cannot dodge accountability. GameStop's balance sheet shows nearly $6.4 billion in cash, but the clock never stops ticking. As digital storefronts eat the world, nostalgia can't pay the bills. The real gamble is whether Wall Street's meme magic buys time or just delays the inevitable. The next move is everything. Drop your take below.